The critical importance of resolving chargeback disputes for merchants. In the complex world of commerce, chargebacks represent a significant challenge for merchants, with the potential to cause substantial financial and operational disruptions. Chargebacks occur when a cardholder disputes a transaction, prompting the bank to reverse the payment. While some chargebacks are legitimate, many stem from misunderstandings, buyer's remorse, or fraudulent activities. Failure to address and resolve chargeback disputes effectively can have far-reaching consequences for merchants. This article delves into the reasons why resolving chargeback disputes is essential and explores the ramifications of neglecting this critical aspect of business management. 1. Financial losses. At the most fundamental level, chargebacks lead to direct financial losses. When a chargeback is filed, the merchant not only loses the sale amount but also incurs additional fees imposed by banks and payment processors. These fees can be substantial, often ranging from $20 to $100 per chargeback, depending on the merchant's agreement with their processor. Over time, these costs can accumulate, significantly impacting the merchant's bottom line. Moreover, for businesses operating on thin margins, even a small number of chargebacks can be financially devastating. 2. Increased transaction fees. Payment processors closely monitor chargeback rates. Merchants with higher than average chargeback rates are often deemed high risk, resulting in increased transaction fees. These higher fees are meant to offset the risk the processor assumes by continuing to service the account. Consequently, businesses may find their operational costs escalating, further eroding profitability. In extreme cases, payment processors may also require merchants to maintain a reserve fund to cover potential future chargebacks, tying up critical working capital. 3. Merchant account termination. Excessive chargebacks can lead to the termination of a merchant account. Payment processors have strict thresholds for acceptable chargeback rates, typically around 1% of total transactions. Exceeding this threshold consistently can result in the processor terminating the account, rendering the merchant unable to accept credit card payments. This scenario can be catastrophic, especially for businesses that rely heavily on credit card transactions. Re-establishing a merchant account can be a lengthy and challenging process, often requiring the merchant to work with high-risk processors that charge even higher fees. 4. Damage to reputation. High chargeback rates can damage a merchant's reputation with both customers and payment processors. Customers who experience frequent issues may lose trust in the business, leading to negative reviews and decreased loyalty. Similarly, payment processors may view the merchant as a higher risk, leading to more stringent monitoring and less favorable terms. Reputation damage can be long-lasting, making it difficult to rebuild trust and credibility in the market. 5. Loss of inventory. In cases where chargebacks are filed for physical goods, merchants lose both the product and the sale revenue. This is particularly damaging for businesses dealing in high-value items or perishable goods. Not only does this result in a direct financial hit, but it also disrupts inventory management and can lead to stock shortages. Additionally, if the merchant is unable to resell the returned item, the financial loss is compounded. 6. Cash flow problems. Frequent chargebacks can disrupt a merchant's cash flow, affecting the ability to manage day-to-day expenses. Cash flow is the lifeblood of any business, and interruptions can lead to significant operational challenges. Merchants may struggle to pay suppliers, employees, and other critical expenses on time, leading to a vicious cycle of financial instability. In extreme cases, cash flow problems can threaten the viability of the business. 7. Increased fraud risk. Merchants with inadequate chargeback management may become targets for fraudsters. Criminals often look for vulnerabilities in a merchant's dispute resolution process, exploiting weaknesses to initiate fraudulent chargebacks. This not only results in financial losses but also increases the merchant's chargeback rate, exacerbating the problem. Effective chargeback management is crucial for mitigating fraud risk and protecting the business from malicious activities. 8. Resource drain. Managing chargebacks consumes significant time and resources. Merchants must gather documentation, respond to disputes, and liaise with payment processors. This process can be time-consuming and labor-intensive, diverting attention from core business activities and growth initiatives. For small businesses with limited resources, the impact can be particularly pronounced. The opportunity cost of time spent on chargeback management can hinder business development and strategic planning. 9. Negative impact on credit rating. Persistent chargebacks can negatively affect a merchant's credit rating. Payment processors and financial institutions often share information about merchants' chargeback rates, and high rates can be seen as a sign of financial instability. A damaged credit rating can make it more difficult to secure financing, negotiate favorable terms with suppliers, or even open new merchant accounts. This can severely limit a business's ability to grow and expand.